Money isn't just currency. It's the story of power. Welcome to Wealixon. There's a pattern in financial history that repeats every time markets reach extreme valuations. It's not random. It's not luck. It's a four-stage sequence that the same type of investors follow with mechanical precision, while ordinary people hold stocks all the way down, losing everything. A small group positions itself to profit massively from the collapse. They don't cause the crashes. They see them coming and they prepare. You saw this in 1929. You saw it in 2008. And you're seeing the early stages of it again in 2025. Here's how it works, plain and simple. Stage 1. Exit. 12 to 18 months before a crash, sophisticated investors begin liquidating positions while markets still rise. Not because they can predict the day, but because they recognize valuations have become unsustainable. Margin debt, leverage, froth, the math breaks. They convert risky, illiquid positions into cash. In 1929, that was Joseph Kennedy. He'd run stock pools in the roaring 20s, and he understood leverage and forced liquidation. When even shoeshine boys were offering stock tips, Kennedy sold into the top and began building short positions. Bernard Baruch did the same. They didn't time the exact day, but they removed themselves from the long trade before the storm. In 2005-2006, Stage 1 looked different, but the logic was identical. Michael Burry and John Paulson researched mortgage underwriting, saw the rot, and began privately exiting conventional long bets on housing while quietly assembling defensive positions. They weren't popular choices. Investors complained, but they recognized the bubble and converted their exposure into something safer. Fast forward to 2025. Who's exiting right now? Warren Buffett sits on a cash pile unprecedented in market history, roughly $325 billion in dry powder. When Buffett says he can't find attractive value, translate that. He thinks prices are dangerously high. That is not small talk. It's capital allocation. Insider selling across corporate America has accelerated to levels not seen since 2007. Jeff Bezos has sold more than $13 billion in Amazon shares over 2024 to 2025. Mark Zuckerberg has liquidated large chunks of Meta stock. Jamie Dimon sold shares for the first time in years. When executives who see the company's real books are selling, that's a signal. Retail investors keep buying the story. AI this, disruption that, while those nearest the machines are quietly stepping off the dance floor. That's Stage 1 in action. The smart money getting off risk while owners and insiders still can. Stage 2. Buy insurance. 6 to 12 months before the crash, these investors don't just sit in cash. They buy protection, gradually at first, when volatility is low and premiums are cheap. In modern terms, that means put options, VIX calls, or credit default swaps. You pay a steady premium when the world looks calm. If the market tumbles, the payout is exponential. In 1929, the equivalent was shorting stocks. Kennedy paid carrying costs while the market rose, but when the collapse came, those shorts exploded in value. In 2005 to 2007, Burry and Paulson paid insurance premiums on credit default swaps for years. They suffered months of losses while houses kept rising. But when defaults came, the payoffs were enormous. In 2024 to 2025, buyers of volatility insurance have been active. The put-call ratio has been elevated. VIX options positioning is telling. Price of protection on commercial mortgage securities and corporate credit has jumped. Institutions are paying up for protection. That's not noise. That's an insurance market signaling an increased probability of a sharp drawdown. Stage 3. Short targeted vulnerabilities. 3 to 6 months before the crash, the smart money doesn't just own insurance. They take active short positions against the weakest links. In 2008, that meant identifying specific mortgage tranches and vulnerable banks. Burry and Paulson didn't short housing in the abstract. They picked tranches, securities, and firms most exposed to toxic loans. When Bernanke and the Fed couldn't bail out every bad balance sheet, those targeted shorts paid off spectacularly. Today, the vulnerable pathways are visible. Commercial real estate and regional banks. Office vacancy rates, permanent remote work, have hollowed out rent rolls. Mortgages written when rates were near zero come due now when refinancing costs are shockingly high. Buildings that supported debt service at 3% don't survive at 8 to 9%. Values drop 40 to 60% in many markets. When owners can't refinance, defaults cascade. Who holds those loans? Largely regional banks. Regional banks already failed before we were in a deep recession. Silicon Valley Bank, Signature, First Republic. Their balance sheets are sensitive to long-duration assets, losing value, and to CRE. Hedge funds have been building positions. Shorts on commercial mortgage-backed securities, credit protection on regional bank bond baskets, increased short interest in specific bank equities. This is stage 3, concentrated bets on specific cracks in the financial system that will widen first when panic starts. Stage 4, buy everything at the bottom. Once the crash forces liquidation, once leverage gets unwound and prices crater, the same players who prepared buy distressed assets at fire sale prices. The cash that sat idle in stage 1 is deployed aggressively. Insurance from stage 2 pays off. Short profits from stage 3 fund the buying. The cycle turns, but only for those who planned in advance. That's how fortunes are made in crisis. Not by luck, by process. Now, 2 final points you should understand. Number 1, this pattern is mechanical and measurable. You can track insider selling, cash holdings of major investors, option flows, CDS spreads, and short interest. Those aren't conspiracy whispers. They're public data. They show the sequence playing out. Number 2, this isn't a warning to panic. It's a primer. There are always 2 types of people in these cycles. Those who get crushed because they stay levered into the top, and those who survive because they prepare. Knowing the pattern gives you a choice. Stage 4, buy everything at the bottom. This is the move that separates legends from casualties. Stage 4 happens when panic peaks. When retail investors finally capitulate. When forced selling, margin calls, redemptions, liquidations, pushes prices below fair value. The exact moment nobody wants to buy is the moment the smart money has spent years preparing for. Look at the historical record. 1932. After the 1929 crash wiped out leveraged investors, Joseph Kennedy and Bernard Baruch re-entered the market, not cautiously, aggressively. They bought blue-chip companies trading at 10 to 20 cents on the dollar. When recovery came, Kennedy multiplied his wealth several times over. He didn't just survive the Great Depression. He built the foundation of the Kennedy dynasty during it. 2008-2009. When Lehman collapsed and markets fell nearly 60%, the smart money moved. Michael Burry used the profits from his credit default swaps not to retire, but to buy undervalued stocks at the bottom. John Paulson took billions earned from subprime insurance and put it into gold, distressed real estate, and undervalued financials. Bill Ackman deployed his massive March 2020 payout straight into high-quality companies at pandemic lows. Every dollar he made from insurance became firepower at the bottom. This is the pattern. Exit early. Buy insurance. Short the weak. Then load up on assets when fear peaks. That's the cycle. It has never changed. Now let's bring it to 2025. Who's positioning for stage 4 right now? The investors sitting on mountains of cash today aren't doing it because they're scared. They're waiting. Warren Buffett, $325 billion in cash. Private equity firms, record dry powder family offices, highest cash allocations in a decade, hedge funds, defensive exposure, massive volatility hedges. Tech insiders, selling shares at the top while publicly telling people, hey, I will change everything. These players aren't confused. They're preparing. Because stage 4 only works if you have cash when everyone else has fear. That's why insiders are selling. That's why institutions are hedging. That's why Buffett is hoarding dry powder. They're not predicting the exact week of the fall. They're preparing to buy the bottom when it arrives. Stage 0. The part no one talks about. This isn't part of the traditional cycle, but it's the one that determines who survives the next collapse. Positioning before the sequence begins. This is the moment you're in right now. Stage 0 is where ordinary investors make their biggest mistake, thinking the top will last forever. Thinking this time is different. Believing AI, tech, innovation, or the Fed will prevent crashes. But smart money has already completed stage 1. They're in stage 2 and stage 3 right now. And stage 4, the buying frenzy at the bottom, is already mapped out. The cycle is moving whether you participate or not. The 2 sides of every crash when markets fall 40%, 50%, sometimes 60%. Most people panic. They freeze. They sell at the bottom. They destroy their own savings. Meanwhile, a very small group gets rich, not because they had better luck, but because they followed the cycle, recognize extreme valuations, exit while everything feels good, buy volatility when it's cheap, short the weakest balance sheets, and, when fear peaks, buy what everyone else is dumping. This is the playbook. It worked in 1929, it worked in 2008, it worked in 2020, and it's setting up again in 2025. Here's the truth most analysts won't tell you. The crash isn't the event. The crash is the opportunity. The event is the positioning before it. And right now, the positioning is visible. Insiders selling at record levels. Institutions buying long-dated volatility. Hedge funds shorting commercial real estate. Regional banks showing stress fractures. Cash piles building. Valuations exceeding every historical red line. You can ignore the data, but the people who manage billions aren't ignoring it. They're acting on it. Before we close, remember this. Crashes don't destroy wealth. They transfer it. From the unprepared to the prepared. From the emotional to the disciplined. From retail investors to institutions. Every market collapse in history has minted a new class of millionaires and billionaires. The ones who understood the cycle in advance. You're watching that cycle build right now if you want to understand what's coming. If you want clarity instead of chaos. If you want to see the patterns the media hides. Then you need to subscribe. Because Wealixon isn't about hype. It's about money, power, and the real forces shaping your financial future. Most channels react to the news. Here you'll learn the structure behind it. The cycles, the players, and the moves that decide who gets crushed. And who gets rich. Subscribe now. Because when stage 4 arrives, the people who understand this cycle will own the next decade. And I want you to be one of them.